Share capital. So what is share capital? Capital of a company is called share capital. If a company has a total capital of, let's say, rupees 1 crore, this 1 crore capital is split into small units or shares. So basically 1 crore consists of 10 lakh shares or units, 10 lakh units of rupees 10 each. Each of these units are called shares. Say shareholder A, owner A, has 1000 shares of this company. Therefore, his capital contribution is 1000 into 10, 10,000. Another shareholder B may hold 5000 shares of 10 each and therefore may have invested 50,000. Yet another shareholder may hold 1 lakh shares of 10 each, contributing 10 lakh of rupees. Therefore, this is the convenience of share capital, the convenience of the formation of a company with n number of owners, n number of shareholders. Each owner, each shareholder may have a small portion of the capital. Therefore, the capital is split into small units or small shares. The capital of a company is called share capital. Share capital again is of several types. Let us understand each one of these types. Authorized capital. Authorized capital is the capital that the company is registered with. It is the maximum amount of capital that the company is permitted to issue. Now, what does this mean? See, when a company is formed, the company has to be incorporated or registered with the Registrar of Companies. The Registrar of Companies is nothing but an agency which ensures that the Companies Act is being fully implemented. So, when a company is formed, the company also has prepared something called a Memorandum of Association. The Memorandum of Association is a book which contains the details of the name of the company, the address of the company, the objectives of the company, and it broadly defines the relationship of the company with its shareholders and the company with the outsiders. That is a Memorandum of Association. Also, usually, having said this, I'll also mention that a company may also have an Articles of Association, which are the internal rules governing the company. In the Memorandum of Association, besides other clauses, there is one clause called the Capital Clause. Under this clause, the company says that this is the maximum amount. Say 100 crores is the maximum amount of capital that the company wants to raise. This that is mentioned in the capital clause of the Memorandum of Association, this capital, which is the amount with which it is registered, this capital is the maximum capital that the company is permitted to raise, is authorized to raise, is called authorized capital or registered capital or nominal capital. This is the maximum amount of capital as disclosed in the capital clause of the Memorandum of Association that a company can raise. This is called the authorized capital. So if a company, let us take an example where a company has an authorized capital of 10 crores. So we are talking of 1 crore shares of rupees 10 each. This may be the authorized capital. What is issued capital? At the moment, the company does not need 10 crores of capital. It only needs 1 crore capital. So, the company makes an issue of 10 lakh shares of rupees 10 each, amounting to an amount of 1 crore. This is the issued capital. Now, when the company issues capital, it basically invites the public to subscribe to the shares of the company. The public may subscribe to the entire issue, may subscribe to more of the issue, or may subscribe to less of the issue. So, if suppose 10 lakh shares have been offered, if the people subscribe only to 9,50,000 shares of rupees 10 each, the amount of subscribed capital would be 95 lakhs. So we have an authorized capital here of 10 crores. We have issued capital of 1 crore. And we have a subscribed capital of 95 lakhs. What is subscribed capital? The amount which is taken up by the public and allotted to them. Mind you, if there was an oversubscription, that is, if the investors had subscribed to, let's say, instead of 9 lakh, 12 lakh shares, the issue was only for 10 lakh. If the public had subscribed for 12 lakh shares, they cannot be allotted 12 lakh shares. They would be allotted only 10 lakh shares, in which case also the subscribed capital would be 10 lakh shares. So, what is authorized capital? The maximum amount that it can raise. In our example, the authorized capital was 1 crore shares of rupees 10 each. That's 10 crores. Issued capital was only 10 lakh shares of 10 each, or an amount of 1 crore. The amount subscribed, let us say, in this example is 9,50,000 shares of 10 each, or 95 lakhs. What is called up capital? A share of, say, rupees 10 could be paid up in installments. So let us say that it is paid as rupees 3, then rupees 2, and then rupees 5. Suppose these are the installments in which it is paid. So first rupees 3 per share is paid up, next rupees 2, and finally rupees 5. So if the company has called up only rupees 3 and rupees 2, the called up share capital is actually only rupees 5 per share into, let us say, 9,50,000 shares which were subscribed by the public. So it's rupees 5 into 9,50,000, which would come to 47,50,000. 47,50,000. Now, what is the paid up capital? Out of the amount which has been called up by the company, it is possible that some shareholder is not able to pay or has not paid the amount. The amount which is not paid is called calls in arrears. So, called up capital less calls in arrears which have not been paid would give us paid up capital. Let us say one shareholder holding 40,000 shares does not pay up rupees 2 per share. A person holding 40,000 shares has not paid up rupees 2 per share. That means we have 80,000 less amount. So the paid up capital becomes 47,50,000 minus 80,000. That is 46,70,000. This would be the paid up capital. So once more, authorized capital is the capital, the maximum amount of capital that the company is allowed to raise. It is also called registered capital because it's the amount of capital with which it is registered, what is there in the capital clause of the Memorandum of Association, or the nominal capital. Issued capital is the amount of capital which is being offered to the public, issued. Subscribed capital is the amount which has been subscribed for by the public and allotted to them. Subscribed by the public and allotted to them. Called up capital is the amount that has actually been called up by the company, because the entire amount which is subscribed number of shares, the entire amount per share need not be called up by the company. So that is called the called up capital. If any part of the called up capital is not paid, the amount which is not paid, the unpaid amount, is called calls in arrears. And called up capital minus calls in arrears gives us the paid up capital, which is what is actually reflected in the total of the balance sheet. There is another concept called the reserve share capital. When it is decided by the shareholders that one part of the capital will not be called up until the company is liquidated. So if it is a 10 rupee share and they agree that rupees 2 per share will not be called up till the company is liquidated, such amount of capital is called reserve share capital. It does not appear anywhere in the balance sheet, but it is called reserve share capital because it has been kept in reserve and to be called up only in the event of liquidation. Let us consider this with an example. XYZ Limited had a registered capital of 50 lakhs. This is the authorized capital, consisting of 5 lakh shares of rupees 10 each. So our authorized capital is actually 50 lakhs. 5 lakh shares of 10 each. Now it has issued 3 lakh shares and applications for 3,20,000 shares were received. Applications for 20,000 shares were rejected and 3 lakh shares were allotted. So what was issued? Our issued capital is therefore issued 3 lakh shares, therefore it is 30 lakhs. 3 lakh shares of rupees 10 each. What is subscribed? Actually, the public subscribed for 3,20,000 shares, but only 3 lakh shares can be allotted to them. So what is subscribed capital? The amount of shares which is subscribed for by the public and allotted to them. Therefore, subscribed capital is also 30 lakhs. We are talking of 3 lakh shares of 10 each. As at the date of closing, the company had called only rupees 7 per share. So what is the called up capital? The called up capital is 7 per share. Therefore 7 into 3 lakh shares, we are talking of 21 lakh. All the money was duly received except for a few shareholders holding 10,000 shares, on which only rupees 5 per share was paid. That means what is not paid? This is called up capital. Paid, not paid is rupees 2 per share into 10,000 shares. This is less. That is 20,000. So that this is called up capital, and 21 lakh minus 20,000. 20 lakh 80,000 is actually our paid up capital. And this is what would be reflected in the balance sheet. Prepare balance sheet from the available information. So what is the information that we have? As per the information we have authorized capital of 50 lakh, we have issued capital of 30 lakh, we have subscribed capital of also 30 lakh, called up capital is only 21 lakh because 3 lakh shares only rupees 7 per share has been called up. Arrears not paid is 20,000 rupees because on 10,000 only rupees 5 has been paid, 2 has been called up but not paid, therefore 20,000 in arrears, so that the paid up capital is 20 lakh 80,000, and this would be the figure which would appear on the face of the balance sheet. Let us take a look at the balance sheet as well as the note to the balance sheet. So here we have equity and liabilities. Under shareholders funds, we have a share capital figure of 20 lakh 80,000. And under cash and cash equivalents, note 2, also we have 20 lakh 80,000. Let us see the breakup of this. It is supported by Note 1 to the balance sheet. So this is how it would be given in details in the note. Note 1, share capital. It says equity share capital. Now, what is equity share capital? We will discuss. We said the share capital could be of two types. Shares could be of two types. Equity shares and preference shares. We'll distinguish them in a while. Now we have equity share capital. Authorized share capital is 5 lakh equity shares of rupees 10 each, 50 lakh. Issued share capital 3 lakh. Shares of 10 each, 30 lakh. Subscribed share capital is 3 lakh shares of rupees 10 each, 30 lakh. I repeat, the public subscribed for 3 lakh 20,000 shares, but the shares allotted to them was only 3 lakh. Subscribed capital is the shares which are subscribed for by the public and allotted to them. Called up and paid up capital is 3 lakh equity shares of 10 each, 7 called up, that's 21 lakh. Calls in arrears 20,000 which was not paid, so that you have 20 lakh 80,000 which is actually the paid up capital, which is what is reflected in the balance sheet. And under cash and cash equivalents, we are assuming all the money is lying in the bank, assuming there were no other transactions, balances with banks 20 lakh 80,000. This is how it is reflected in the balance sheet and the note to the balance sheet.